all you're going to do in this main point of this class is you're going to learn about all these different types of transactions, which actually gets really interesting. Like this is really what you're going to do in business is you look at transactions that might have occurred in the past or some that might be really new, especially if you're in the Silicon Valley. And then you're going to go through these transactions, understand them, and then post them to the journal. And then it gets posted to the financial statements. And those financial statements are then used by investors to trade in the stock market, right? So it's a very high impact and relevance to what we're doing in the world. And so I want to go through some transactions real quick so you can see how that flows. Like, so let's say I'm building a business. I'll walk through this example again. I build a business and I put $10,000 of stock into that business. I'm going to teach you about all these different types of transactions. You can become an expert in stock transactions. It's actually a very interesting area. We're just doing high level for this class. And so I'm going to put cash into my business in exchange for stock. Stock has an interesting complexity to accounting. It has something called a par value for stock. And so that's the idea of the minimum liquidity you need in your business, the minimum amount of cash you need in your business for your business to stay viable. But it's an arbitrary amount that you can set legally. It's a strange part of law that you can learn about. But for all you need to know is that the par value will be treated separately than the total value in these two accounts. We're going to go in this detail. I'm going to keep it high level. But so the concept here is I debit cash and then credit stock. And there's these two stock accounts to track the difference between the par value, the $10 of par value, which is this 1 cent times 1,000, and the additional paid in capital. This equals the 10,000 of the cash. I want to go into details on how to do that in later lectures or what these accounts are, but just know that these are additional equity accounts that you'll learn about. Then we go through, okay, does this transaction, do debits equal credits? Yes, debits equal credits. Why? Because assets are a debit normal balance that increases, assets increase through a debit. We have cash, cash is an asset, cash goes up 10,000, debits go up 10,000, then credits go up 10,000. And so then the question is, do we have, let's make our financial statements. From our last class, we know the order of financial statements. We make our income statement first. My business hasn't had any income yet, so we don't have an income statement. We then make our statement of shareholders' equity. We have equity of 10,000 from common stock and our APIC. And then we make our balance sheet. Our balance sheet, our assets equal our equity of 10,000. And then we make a statement of cash flows after. So we can see how the business has made the cash. The cash has come from the issuance of stock. That's it. So that one transaction, we journalize it. We make sure that the debits equal credits, assets equal liabilities plus equity. And then we see how it impacts the financial statements, balance sheet, income statement, statement of cash flows. That's the whole picture. And so let's say I have a question. I want to make sure I'm answering. Yeah, for expenses, debits are the normal balance. That is correct. That's correct. Because they reduce equity. Yep. A question? Another question?
Yes. What's par value?
Par value, I'm going to go into detail on stock accounting in a future lecture. But the concept of par value for stock is stock itself has a par value and an additional amount that people pay for the stock. The par value is an arbitrary number set legally. So like in articles of incorporation, when you build a company or draft a company, the owners can set the par value. There's a legal liability associated with making sure that your company always has that much money in the par value of the stock within the company. But most people set it at a very low amount, but you still have to track it for accounting purposes.
All right, thank you.
So if you look at any financial statement, no problem, good question. You'll see common stock of Apple might have 10 billion common stock at 0.00001%, 1 cent par. And then you'd calculate it separately like that. I'm going to go over one more transaction because that's how you're going to get good at this is just transaction. I've looked at hundreds, probably tens of thousands of transactions in my life. And the more you do, the better you'll get at accounting. It's really a practice. So let's say for my consulting business, I need a laptop, right? Let's say I need a laptop. We're going to go into what depreciation is in a bit, but I want you to show the type of transactions. I buy a laptop for my business so I can do my consulting work. Laptops are what? They're an asset. They're something that I'm using for my business. And what am I paying for that asset? Cash, right? I'm trading one asset for another. So I'm giving my cash for a laptop. I'd debit my laptops and I'd credit cash, right? Debit laptop, which is an asset because I'm increasing the asset, and I'm crediting cash because it's decreasing the asset. And then I'd have a depreciation expense associated with that asset because we have to match the expense with the revenue it generates. And so we'll go over in detail how to do that. I just want you to become familiar with these entries, and you can watch the video for more detail on what depreciation actually is, but we'll do that in a future lecture. Then we make sure our debits equal our credits. So our assets are 1.8K and our depreciation specs 50. So our total debits are 1,850 and our cash decreases, our credit, our cash 1,800. And then we'd have an account called accumulated depreciation, which we'll go in, which is 1,850. And then you'll see how it flows through the financial statements. Our financial statements, I'd have an expense related to my depreciation expense. Note that my laptop isn't an expense yet. I've capitalized, it's a long-term asset. I don't have an expense related to it. The depreciation is the expense. You'd see how the equity statement would now have an accumulated deficit. And now assets will always equal liabilities plus equity. My equity would decrease 50 and the value of my net equipment would change 50. And then you'd see the statement of cash flow here. My investing activities, my purchase of equipment would have I'd lose $1,800. I'd have a loss related to my depreciation. And then my cash would equal the 10,000 minus the 1,800. And so I'm giving you a lot right now because I want you to see the full picture, or else you're going to get lost in the weeds. And too many other accounting professors you're going to get lost in the weeds. The big picture is you are making financial statements with this information. That's why you need to know the journal entries. That's why you need to drill them. And so that's what all of these slides are. And all of the videos I've shared, I have a lot of videos related to this, are just a bunch of journal entries that you need to memorize. But to do these journal entries correctly, you need to know your debits equal credits, which accounts are debits, which accounts are credits, and how debits and credits impact those accounts, which is everything we just went over. You need to memorize this and drill it through your homework. And so there's lots of journal entries here. And if we have time after class, we're going to go over them in detail.
So I have a question.
Yep.
You said when you bought the laptops, you credited cash, which means that you reduced cash.
Yep.
But isn't it counterintuitive that you're crediting something, but you're reducing it?
That's a problem with just nomenclature. It's a problem with just language that we use in our day-to-day lives. People say credit and they think it means reduce. They're wrong. Credit doesn't mean reduce. It's been misconstrued. The definition's been misconstrued. The definition originally came from accounting, just so you know some context. Like, of course it came from accounting. But when you think about getting a credit, like let's say Amazon messed up your order, so you get an Amazon credit. Amazon's looking from their perspective, not yours. That's where it came from. Amazon saying, oh, we're giving you a credit because it's a credit to their cash. The bank's giving you a credit from their perspective, not yours. So that's why it tricks. We're too used to thinking of us from the consumer view, but we're the business owner. We're the business now. We have to think from the business's view. That's why I say, don't forget what you know about credits. Credit to you now means right. That's it. It's the right side of the account. And you have to memorize it in this new framework, because now you're no longer a consumer. You're going to be an accountant. Is that fair?
Thank you.
No problem. Any other questions? Awesome. So I could go through all these journal entries, but I want you to go through them yourself. And if we have time after class, I'm happy to spend some extra time walking through all these different entries. But what I need from you before we can do that effectively is really memorize your accounts and practice these. Practice it on your homework and go through the videos I've provided. Let's see, debit and credit. So this is just a bunch of practice. You can follow all these yourself. Let's see.